Imagine this: global LNG trade is at a breaking point. Promises are being made on the political stage, headlines scream about massive energy deals, and leaders proudly declare big wins for their countries. But behind the cameras, ships aren't sailing, ports are backed up, and critical cargo isn't arriving where it's needed most. Asia's demand is skyrocketing, the United States is eager to dominate exports, and Europe is quietly pulling cargo away with price incentives. So here's the big question: are we watching a historic LNG boom, or a slow-motion breakdown of energy diplomacy? This is more than just business. This is about power grids, energy security, and the future of global trade routes. And if you're wondering why announcements of huge LNG volumes haven't translated into actual deliveries, you're about to find out why physics, infrastructure, and shipping schedules, not politics, are running the show. Before we dive deep, let me ask you: do you believe political deals can really fast-track energy supply chains? Or do you think markets and logistics ultimately decide? Drop your thoughts in the comments now, because by the end of this video, you're going to see why LNG trade is one of the most brutally realistic markets in the world, and why no amount of campaign slogans can change the engineering realities behind every ship and pipeline. So, let's start with a simple truth: announcements are cheap, but delivery is expensive. Every LNG trade deal sounds glamorous when leaders shake hands in front of cameras. Headlines flash numbers in the hundreds of billions of dollars. But on the ground, what matters is when cargo leaves a terminal, how much it costs to deliver, and where it actually lands. And this is exactly where theory and reality start clashing. To understand the bottleneck, we need to break LNG trade into three moving pieces: production, liquefaction, and shipping. First, let's talk liquefaction. Every U.S. facility adding LNG capacity, whether it's Corpus Christi Stage 3 or Golden Pass, is doing it through liquefaction trains, and each train is a massive industrial project. Commissioning isn't flipping a switch. Even after construction, facilities take months of testing, calibration, and cooling before their first commercial shipment leaves. So when politicians announce massive new export commitments, the first regular cargo flow often doesn't begin for months, sometimes a year or more. This is why Asia's hunger for LNG isn't being met overnight. The energy infrastructure just doesn't move that fast. Now, let's talk shipping, the second leg of this puzzle. LNG isn't oil. It doesn't move under pressure in giant tankers. LNG ships are specialized cryogenic carriers running at -162 degrees Celsius. And this temperature-driven design means the fleet size and availability matter far more than people think. Every voyage to Asia takes longer than a European route, especially if you're crossing the Panama Canal, where drought conditions have turned transit into a high-stakes auction for passage. Reservations are made weeks in advance, and if you can't secure a slot, delays or reroutes through the Cape of Good Hope make cargoes more expensive and less competitive. That's where price arbitrage comes in. This is the invisible hand that dictates every LNG cargo's final destination. When the price spread between Europe's TTF benchmark and Asia's JKM narrows, even a strong Asian demand signal can't outbid Europe's pull. That spread, sometimes just a few dollars per million BTU, can completely redirect shipping patterns, regardless of what governments want. Imagine a cargo that was promised to Asia suddenly landing in Europe, because it's simply more profitable after shipping costs and risk premiums. That's the brutal math of LNG markets. And this is where rhetoric crashes into reality. But let's pull back and look at the politics, because this is where things get really interesting. Politicians are quick to announce massive LNG deals, often as proof of strong diplomacy. But when buyers, especially in Asia, hear these promises, they don't cheer. They scrutinize. They want hard answers, delivery schedules, pricing formulas, and flexibility clauses in contracts. No one cares about a headline if they can't plan their refinery schedules or power plant fuel needs around it. In other words, the market translates every loud declaration into one question: when will it ship? Now, consider this: Japan, South Korea, China, and India each approach LNG differently. Japan is all about long-term contracts with flexibility built in. South Korea balances LNG as a stable baseload while leaving room for spot adjustments. China mixes spot purchases with medium-term contracts to manage seasonal price swings. And India only enters LNG agreements when the price falls into a narrow affordability range because of currency and financing concerns. These countries don't respond to flashy announcements, they respond to math. If the infrastructure isn't there, the contracts don't get signed. This brings us back to the United States. Domestically, demand for natural gas is booming. Power plants are switching to gas, data centers are consuming unprecedented electricity, and industrial facilities are adding pressure to domestic supply. This creates a fascinating tension. America wants to dominate LNG exports, but domestic users are pushing prices higher at home. That opportunity cost becomes part of the equation for every exporter. Should they sell abroad or keep supply domestic to control local energy prices? This balance is becoming one of the defining challenges of U.S. energy strategy. And yet, even with all these complexities, U.S. LNG capacity is expanding. New trains are being built, port upgrades are underway, and projects are hitting milestones. But don't mistake growth for instant dominance. More liquefaction trains don't mean all cargo will flow to Asia immediately. Europe's demand is equally strong, and when price spreads narrow, LNG shipments often follow the path of least resistance. Again, this isn't political favoritism, it's market physics. Let's add another complication: tariffs. U.S. trade policies add cost layers to the LNG business, not just on the gas itself, but across related infrastructure. Tariffs on steel, aluminum, shipping equipment, and even port services add uncertainty to project planning. Every unexpected tariff or regulatory change becomes a reason for companies to delay investment or reroute cargoes. And when you combine tariffs with geopolitical tension, you create a built-in risk premium that gets priced into every single cargo. So why do so many announcements fall flat? Because LNG is fundamentally an engineering business, not a political theater. Let's take a hypothetical. Imagine a country announces it wants 20 million additional tons of LNG annually from the US. That's the equivalent of building a new mid-sized liquefaction facility from scratch. That means years of environmental permits, engineering, procurement, construction, offshore port integration, and pipeline connections. Every single point of that chain has its own risks and delays. You can't rush it for headlines. It's industrial reality. But let's get practical. How should energy policy shift to make these promises real? First, there has to be a realistic assessment of capacity, actual MTPA timelines, port compatibility, and vessel availability. Second, policy has to acknowledge market spreads. Instead of saying Asia under all conditions, contracts need flexible routing clauses tied to JKM/TTF spreads. And third, domestic market balance has to be part of export planning. If LNG exports compete directly with domestic power plant demand, both price and supply stability become vulnerable. This brings us to Asia's perspective. Why do countries like Japan and South Korea continue to diversify their suppliers even as US LNG capacity rises? Because grid security depends on portfolio diversity. If one supply chain falters, others have to compensate. Qatar and Australia already anchor the LNG supply chain for Asia. The US adds flexibility and price competition, but will never become the only supplier. This isn't mistrust, it's risk management. Now, here's where it gets fascinating. Despite all this complexity, LNG remains one of the most trusted forms of energy trade because of one critical factor: trust reduces costs. When contracts are transparent, routes are reliable, and schedules are clear, risk premiums drop, and everyone wins. That's why clear, predictable trade rules are worth billions of dollars in savings. But trade policies that move back and forth, surprise tariffs, or regulatory whiplash destroy that trust and drive costs up. So the question isn't whether the US can grow its LNG share in Asia, it already is. The question is how to grow that share strategically without overpromising. Every bold statement needs to be backed by liquefaction schedules, ship allocations, and pricing strategies. Because here's the truth: the LNG market doesn't care about political speeches. It cares about spreadsheets, pipelines, and physics. If you've been following LNG trade, you know the Panama Canal's reduced capacity has thrown shipping schedules into chaos. This single choke point is reshaping trade flows, sometimes forcing carriers to sail thousands of extra miles, adding days to every trip. So ask yourself, can an Asian buyer really trust a headline saying, "We'll take it all," when shipping realities say otherwise? The market is telling us something powerful right now. The real growth story is going to be slow, steady, and engineering-driven. We are going to see capacity expand, but instead of a single political victory, the LNG trade will evolve through incremental gains. And that's why buyers are diversifying, signing flexible contracts, and building a portfolio approach to energy security. So, next time you see a headline about LNG trade deals worth hundreds of billions, remember this: the market doesn't reward hype. It rewards delivery. LNG trade isn't a sprint, it's a marathon. It's about capacity timelines, shipping routes, and pricing models. Physics wins, not politics. Now I want to hear from you. Which adjustment do you think matters most for balancing LNG flows, flexible delivery terms tied to price spreads, or long-term slot guarantees at shipping choke points like the Panama Canal? Comment below because your perspective will shape the discussion in this community. If you found this breakdown valuable, hit that like button to help this video reach more viewers who care about global energy and trade. Make sure to subscribe so you don't miss future deep dives into LNG markets, energy geopolitics, and the strategies that shape our world. And turn on notifications because this conversation isn't stopping here. Thanks for watching, and remember, energy diplomacy isn't built on big words. It's built on strong plans. And the smartest players know that trust is the cheapest way to cut costs in this industry. See you in the next one.